Hello, I'm Gary Korolev with Sovereign Wealth Management, and it looks like it's time for another market update given everything that's been going on in the economy over the last few months. So let's start with the indices. We're looking at starting 2020, and let's start with the S&P 500, which is the green line. Of course, we started off with a big crash here in March of 2020 with COVID, and then it was pretty much a straight line up. And as the inflation fears started ramping up and the liquidity at the same time, the assistance from the government started drying up, we started seeing the market kind of starting to weaken. And then, especially at the beginning or at the end of 2021, we started seeing a pullback. And now we're experiencing a correction here that's getting to be close to 20% off the highs. So close to being an official bear market at this point. And usually when stocks go down, rates go down as well, which makes bond prices go up. But what's happened recently is the Fed has not been able to lower interest rates because they're afraid that inflation would go up. You can see here that inflation is at 8.3%. Now, when is the last time you remember it being this high? It's the highest it's ever been since around 1980. So that has really spooked the Federal Reserve into talking tough on inflation, which means they really can't rescue the market, so to speak, as they did in the past. As we know, they would jump in anytime the market went down 10 to 15 to 20%. So now they're really trying to scare off the market, so to speak, and scare off people from thinking inflation is going to continue to go up. And so they really can't come in and rescue the market as quickly as they could in the past. And since inflation has been fairly persistent, the Fed hasn't stepped in to make rates go lower. Bonds, consequently, have also been selling off. You see this blue line are bonds. So this is the 7 to 10 year Treasury bond ETF. And as you can see, when stocks started selling off, bonds did not do the opposite as they used to in the past. They started selling off as well, going down here. People have been expecting their bonds to save them when their stocks go down. Well, it hasn't been the case year to date. However, we have started seeing bonds leveling off at this point and really even starting to go up a little bit. It could be a bounce, but bonds have been so oversold that it's likely that inflation is not going to continue to go up. It's likely that inflation will either level off or even go down somewhat, which means bonds can start seeing some reprieve and also becoming more attractive given the yields have gone up so much on treasuries and on corporate bonds, whereas you could get close to 3% on an intermediate term bond at this point, which was difficult to do a few months ago. So that means that there's potentially more people getting into the bonds as a way to get income versus a year ago. So the red line, of course, is volatility. And volatility pretty much is negatively correlated to asset prices. The more volatility, the lower stocks or other risk assets go. Of course, it spiked here during COVID and went back down with all the liquidity in the market. And now we're seeing it starting to go up again, but of course nowhere near the levels what we saw during COVID. Still much higher than it was when the market was going straight up in an orderly fashion. Here, the green line is the S&P 500. Now, one very volatile and risky asset that did very poorly last decade for the most part has really done stellar since COVID, and that's commodities. If you look at this purple line, you see a line that's straight up. We're starting to see energy shortages. Some of them are self-imposed due to sanctions with the conflict in Europe, and of course some of it is with the green transition from fuels which use higher carbons to fuels that are renewable and are cleaner. But all of this together, of course, has created an artificial shortage, which has really been the biggest reason behind the inflation. So it's not 70s-style inflation where the previous generation had a bunch of children and the baby boomers are coming of age in the 70s and women are going to work and everybody's trying to buy houses and expand households, which creates a lot of new and sustained need for goods, which keeps inflation high. Now, really, we have a shortage of basic goods like energy and commodities. Other commodities, agricultural commodities. And when that happens, people have to spend more on these basic goods, which means they can't spend on other things, which otherwise would make the economy go up. So really, that's why you may have heard the argument that this inflation should go away eventually. And I don't completely disagree with that argument. Maybe inflation will be as low as it used to, but it certainly should level off if people can't afford to buy as much because commodities cost so much, like food and energy, then really demand should come down and inflation should follow. And that's what the Fed is hoping for over the next few months. Now, this yellow line, of course, is gold, and it led the way up out of the commodity or out of the COVID crisis, and it went straight up by about 50%. But then it's leveled off since then. It's gone kind of sideways and is corrected recently. So if we take a look at mortgage rates, so what we're seeing is the 30-year fixed rate. If we look at better credit ratings, you're looking at about a 5.5%. That's much higher than mortgages were just a year ago. You could get a 3% mortgage. So the question is always, is the sell-off going to continue, and should we be looking at reducing risk in portfolios? And in our models, we're watching this closely, and it's getting close to the point where we would potentially look at selling off some of the more aggressive assets in the portfolio and wait for a moment to things settle down and allow for a move back into the market. In the meantime, if you have any additional questions, please follow up with us via phone or email.